Hi and welcome to this week's edition of Macro Minutes. I'm your head of trading, Mark Gardner. Hope you're all safe and well in lockdown here in Australia at the moment. We'll start with a disclosure statement. This does not constitute financial advice, is general in nature and does not take into account your specific circumstances, should not be acted upon without considering your full situation and future goals. Stocks in our universe this week, we've got Transurban, CBA and QBE. TCL reported mixed results in their financial year annual report on the 8th of August. Traffic decreased by 0.4 compared to the financial year 2020 due to intermittent lockdowns in Australia and globally. Dividend of 21.5 cents was previously announced, representing a dividend yield of 1.6%. They went ex-dividend on the 29th of June, the dividend payable on the 23rd of August. While the company did not report any major acquisitions, it did note the completion of 5 projects on time within its forecasts. North American projects saw no revisions, and to their deadline. However, Melbourne's Westgate Tunnel continues to face delays due to stagnant negotiations. Decreasing net income figures resulted in a 13.5% drop in free cash flow. Releases dropping 42 million as management intends to focus more on refinancing its debts due to favourable interest rate conditions. Next up, we've got CBA. They reported their results a couple of days ago on the 11th. Their full year performance was largely in line with expectations. The final dividend of $2, representing a 1.9% yield on yesterday's closing price, was slightly below expectations of the market. Saw their net interest margin tightened by 4 basis points to 2.03 year on year, which was expected due to the current interest rate environment. Their revenue was 24.2 billion, which is in line, a 1.7% improvement compared to the previous year. Moreover, the company announced a $6 billion off-market share buyback, which, following the result, which is estimated to reduce CBA's share count by 3.5%. So next up, we've got QBE, which is one of the investing recs. I think it hit price target yesterday as well. So they had their half year and the full year results on the 12th yesterday, with group-wide profits up 20% to 10.2 billion, while also announcing a dividend of 11 cents. Net profit for QBE buoyed to 441 million, a healthy recovery from the net loss of 712 from the previous period, reflecting strong premium rate environment. Net investment income also rebounded 58 million, which is about a 0.4% improvement annualised return. That was for the half, reflecting narrower credit spreads, which is more than offset the negative mark-to-market impacts of higher risk-free rates in fixed income assets. We did recommend that on the 7th of April, 2021 at 9.77, and as I said, it hit the price target yesterday at 11.95. Actually, it opened through the price target at about 12.10 or something like that. So that's returned 22.3% after the half-yearly results beat expectations. So well done to the guys there. I think the current strike rate for reporting season for these guys were 5 from 5 for the ones that are going to beat expectation. Although we're pretty early in the reporting season stuff. So far, I think there's only been probably about a third absolute tops of companies reporting. So trading stock of the week, we've got Oz Minerals. This is a previous rec from both a monthly feature play perspective and just a normal weekly or ad hoc recommendation from the trading department. It's currently trading around just under the $23 mark. They had great quarterly results around about 2 to 3 weeks ago, and but the share price has sort of drifted off from then. As you can see in the chart there, there's it's respected the 200-day moving average. It's roughly at the price which was recommended previously, and we'd be looking for it to continue that lovely trend channel that was showing up there. So you can enter around here, around this $23 mark. The outlook for copper, we've had lithium stocks rallying pretty hard over the last couple of weeks. I think names like Galaxy and PLS, etc. And I think what's being overlooked and lagging a little bit is that there's actually more copper used in electric vehicles than there is lithium, to be honest. and the making of most electronic devices, plus that infrastructure bill's gone through. We do expect Oz Minerals to beat expectations, although it doesn't really report till the end of the month. So keep an eye out for that one, but I can honestly see this thing going through 52-week highs or all-time highs over the next 6 months. So we've got a target price there around about the 29.90 mark. Stocks to watch out for: we've got BHP, we've got Magellan, and we've got an Aero Group. So BHP will release their full year results on the 17th. We've had quarterly updates as well, which were very positive for BHP. But the post-recession recoveries involve the development of infrastructures, which revolves around commodities. In 21 financial year, BHP was able to significantly profit from iron ore, which hit an all-time high. Iron ore has pulled back quite considerably, though, about 35% in the last 4 to 5 weeks. They're expected to perform very strongly in financial year 22, particularly through their positions in copper, coal and oil. That coal position, I think, is about 14% of their total business. It didn't contribute to their reporting last season in February, but the coal price has almost doubled since then. So that will start to really contribute to the bottom line. Iron ore is currently expected to continue to fall for the moment, although, as I said, it's dropped about 35%. It's well through the 200-day moving average, I think 20% below the 200-day moving average, which is a rather large correction. And as the global economy starts to come, heat up and get through these COVID lockdowns that are going on, and the vaccination rates go higher, we probably should see the demand increase there again. So copper reached a 10-year high in April, which is a significant benefit to BHP. It's expected that copper prices will continue to climb as demand grows over the next decade. This week, BHP resolved a workers' union strike at their Escondida mine in Chile, which was a big concern. It's the world's largest copper mine. Due to no bonus being issued for working during the pandemic, the one-off increase in the employee benefits expense is unlikely to affect their strong all-round growth. They've got many mines, so increasing wages in one place is really not going to affect their bottom line too significantly. Revenue and EBIT are expected to increase by 35.4 year on year and 87.8 year on year respectively, translating to about a $2.76 dividend, growing by 130% year on year. You can't ask for much more than that overall. Next up, we've got Magellan. They'll be releasing on the same day as BHP. They've had a mixed performance in the financial year, growing 17.2% to a total of 113 billion funds under management. Net outflows totaling about 351 in Q4 due to the global funds' weak performance relative to the market index, which is rallying to all-time highs throughout the pandemic. Similarly, infrastructure, which has historically outperformed the market over the last year, underperformed by 9.4%. The market expects revenue to be below the 2020 levels. However, it's expected Magellan will rebound in financial year 22 with its newly launched retirement income future play, which is already sort of growing FUM. It looks pretty good on the chart, around about that $50 mark. So those value plays with the market probably likely to go a little bit sideways this year, and probably not have the astronomical returns we had last year. Value-based funds will do a little bit better, of which Magellan is one. So next up, we've got an Aero Group. They'll be releasing their full year results on the 18th. Consensus estimates for Avita and net profit growth are 80% and 69% respectively. They provide marketing communication services to multinational clients, primarily in Australia, 40%, the UK 24%, and the USA 36%. For blue chip clients, including Adobe, Facebook, Zoom, Google, and the Australian government. So I dare say there'll be a lot of government spending there with all the COVID ads that we're all seeing and continuously being blasted with, and there'll be election spending as well, I suppose. So you would expect those numbers to keep up for the Australian government. During 2020, the pandemic drove increased demands for tech products, resulting in an 18% year-on-year growth in the US. for tech advertising relative to 1.7% for overall US advertising market, with key clients expected to continue capitalising on this increased demand. They're expected to increasing their marketing expenditure in the next few years. As other industries continue to recover from losses in the pandemic, companies will likely pursue aggressive advertising strategies to recapture lost market share. EGG acquired UK-based McDonald Butler Associates, bolstering their account-based marketing services and expanding their client base to Deloitte, PwC, Amazon Web Services, and IBM. So that's a pretty thin stock overall. From a trading perspective, we've played around with that. Played around in that stock quite a bit. It's worthwhile having bids below if you're liking this stock, because it does go on quite strange intraday runs sometimes. So, but overall, the outlook's pretty good there for EGG. Looking ahead, we've got US retail sales, FOMC minutes, and Australian employment. US retail sales is obviously the primary gauge of consumer spending in the US, contributes to the majority of economic activity. Core retail sales data, which excludes automobile sales, and they'll be released all around the same time. So look, it's a good lead indicator of economic spending. Next Thursday at 4 a.m, the FOMC minutes will be released. They come 3 weeks after the FOMC meet. Provides detailed insight into their economic and financial conditions and how they voted. We've had some pretty hawkish members of the Fed come out lately and say that if we get another payrolls like we had last Friday, which was up 920 or 950 odd thousand, that's probably going to give the green light for tapering, which might sort of hurt that tech sector a little bit. Because it's not really in line with the whole living with inflation thing. So there could be a little bit of market reaction to that. And obviously next Thursday, we've got Aussie employment data. It's a bit of a lagging indicator. We're going to have a lot of lockdown stuff involved in it. I think the market will largely ignore it unless it's a super strong number. And overall, I think that just with the rolling lockdowns, we're going to have a bit of a wait and see attitude from the RBA. So whilst always fairly important, it's definitely it's definitely one to keep an eye out, but it's probably not going to have a huge effect this time around, just because of the uncertainty of the general numbers and the sample size. Not being quite big enough to really give an absolute clear picture with that lockdown being involved. All right, so that's thank you for listening to the Macro Minutes for this week. Have a good week, and keep your eye on those reporting season stuff. Keep your eye on your inbox from our research department for those updates about reporting season. It's going to be a busy couple of weeks, and your holdings may have runs either way. So be mindful of of your target prices, etc. And we'll talk again next week.